Welcome back, everybody. It's good to be back doing our typical Friday stuff, and glad it's Friday as well. I'm heading to a big weekend with family and friends in New York City, and escaped Hurricane Ian in Tampa, and got up here on Tuesday. But thankfully everything was fine in Tampa. Tampa remains to have not had a direct hurricane hit in 50 years. So we were looking for that outlier, and it definitely hit other parts of Florida. And friends and family that we have down there. So was not a perfect situation by any means, but we sort of dodged some bullets on that. My boat survived. So my son is very happy about that. So all in all, time to move forward and clean up. And thanks to everybody for wishing me a happy birthday and for asking about being concerned about our safety in Tampa. So Tampa's a wonderful place, but there is some downside to all that wonderful temperatures almost all year round. But glad to live there and glad to be in New York this week and had a lot of fun. And I wasn't very into the markets as much, which is probably good. Just letting my system do its thing. I did tweet that I'm going to let my algorithm run forever for the next 100 years, hopefully. So nothing deters the algorithm from running and the trades to being done as long as I pay those people to do all of that. So kind of crazy week. I've seen periods like this before where the world's falling apart, the markets are crazy, and it's good for the trend followers, and everyone else is totally baffled. And it's crisis and chaos. So it's a little bit of anxiety when you make a lot of money quickly and the trends are in your favor, as well as when you lose money. So it's not perfect, but at least we're on the right side of these trades so far and right now. It just goes to show you how important shorting is and having a full complement of markets, currencies, commodities, stocks, bonds, shorts. There's no place to hide sometimes. So you've got to have those shorts on. When I first started trading in 1984, I think it was mostly shorting. And every now and then it really works out well. I didn't get I'd like to go in and listen to Rich on the podcast multiple times, and I haven't been able to. I've only been able to listen to Rich's latest a few times, but it was very good, and hopefully we can talk about that. If you guys are not listening to every opportunity you get to listen to Rich talk about trend following, you're really missing out. And I saw that he has a new job. I haven't heard about this, but hopefully his new responsibilities won't take away from all the free stuff he gives all of us every now and then. But anyways, you should go back and listen to, whenever you can, go listen to Rich talk about trend following multiple times like me. And I was just tweeting so much of what he was saying that I just had to stop. I'm like, okay, I'll stop now. I'll come back later. I can't have 50 tweets in a row about something, quoting something Rich said, but I'll get back into it next week when I'm back home. But I really want to maybe talk about some of that stuff if we can. Anyways, good morning, Oleg. I think you're ready. What do you think?
I'm ready today. Good morning, Jerry. Good morning, all the guys here. I will say I did not slept well this night, so my English is maybe not as out of perfect today, but as well as Russian. But I was worrying about Tampa, and I even wanted to write to you, Jerry, but saw that you are tweeting in Twitter, and I thought that's always okay. And I know what hurricanes is because in my hometown, Novorossiysk, periodically, maybe 2-3 times a year we have small hurricanes from the mountain. It calls Nordost, famous by the way in Russia, in Europe maybe, and because scientists don't know the nature of this hurricane, and it was maybe in 2012 in winter. It's usually winter hurricanes, and in winter in 2012, and there are a lot of photos. It was like an Antarctic. We live in the south, but it looked like an Antarctic. It was near 1 meter of ice near the sea. So I know a lot about the hurricanes, not tropical storms, but this kind, and I was worrying about this. And also, I was worrying about all the road, to be honest. But I'm happy to be here. I'm happy that I'm a trend following trader, that I know this great philosophy, and happy that I can take part in such wonderful discussion. So a lot of happiness in my life.
G'day, Jerry. G'day, everyone. Good to see you safe, Jerry. I saw pictures of the hurricane, or we call them cyclones down here, but the circumference of that beast was amazing, and I just couldn't get over how large that storm cell was. It was quite impressive. But good to see you safe. Good to see you back on board. And hi, everyone. I hope it's going to be a good conversation. I've sort of run out of ideas to think of myself, but hopefully people bring up some good things they want to discuss.
Hello, everyone. Hey, Jerry. Hey, Richard. Hey, Oleg. Hey, guys. I mean, this week has been phenomenal, isn't it? I mean, in terms of this Bank of England, move, and basically they've just interrupted the markets when the short gilt position actually just going like crazy, and after their intervention. Things have changed. So I think up until this moment in 2022, when I was just comparing my memory with the 2008, and I thought that everything else was going pretty orderly, but this week things just started to get a little bit disorderly. So this. I'm never a fan of central bank interventions to the markets, but these things do happen, and our systems needs to allow these cases where when we try to make money, when we make money, we need to allow for our mistakes. So our mistakes needs to be in that system. So we need to allow for brokerage commissions. We need to allow for taxes, and surely we need to allow for central bank interventions as well. So, however unfortunate they are, they are just part of the game. And these gilt positions were actually, I've shorted it. It was, and I didn't have a lot of. The first position was quite from a small wall, so the position size was higher. But then after the intervention, I've been stopped out, and I was making something like 6R. I guess now I ended up the position with two R multiples, which is fine. But then it reversed, and we'll see where is it going to go. So yeah, it was quite an interesting week, and maybe we'll see more disorderly days coming ahead of us. Thank you.
I think this week has shown again that you can expect the unexpected. So I think a lot of people got caught by surprise, especially if you're like long only, or if you only accounted for a certain amount of risk. Because I don't know the ins and outs, but I heard that on the pension side, they only accounted for a certain amount of risk that they saw in the history, but not as much as what has happened, because obviously that was unprecedented. So it just shows you that risk management is very important, but also that you need to allow your system to obviously be able to react in situations where that you might have not seen before. And that shows in how robust your system is if it is able to do so.
I think it's a good word because of course our transform will always talk about this, and it's always have a lot of sense to understand that our transforming systems they are adaptive, and of course we will see, and Jerry said this many times, and it's very important to understand that we will see a lot of times something that we never have seen in our history, and we will see it's a quality of our world, and of course our system, our adaptive transforming system, adaptive transforming philosophy will be with us, will help us, will support us.
Jay, glad everything is okay and you are safe. You guys have a lot of experience with these tail events. Yeah, my model, trend following, got a hit on the 28th, fell about 5%, but yesterday it recovered due to the short position in equity indexes. The positions now are, okay, I'm still working on this, okay, it's back testing, working on the model for next year to put in production. Okay, it's long the dollar index, that's a good profitable position. The OJ is also long, good profitable position. Live cattle is losing a little, and all the other positions are short. The 10-year, the Euro bond, the Euro stocks, Buxal, I don't know if I pronounce this correctly, the cocoa, silver, platinum, copper, gold, crude oil, Brent, and the DAX, along with the E-mini are the short positions, and recovered yesterday about 2 to 3%. This is a challenge in research because this is a new regime now. I just retweeted a tweet from yesterday about the long yield. He made 8 standard deviations move on the 28th, based on, of course, first differences of the price. That's an unprecedented move. I think it will take a long time for this to settle. It's a mix of economics and politics, I believe. It's not only economics. Okay, back to you.
Thanks, Michael. Yeah, I have most of those same positions on too. So I think in a situation like this, I've been short gilts for a long time, a year. I'm not sure how long, but I haven't done a gilt trade in a long time, except going short. And I'm not going to do a gilt trade in a long time. And my whole mentality is, it's a profit. It's a profit, so I don't have really anything to do. My long-term trailing stop is so far away. My pants are so loose on all of these trades, but even gilt. And it's 1 out of 200 markets. So for all of those reasons, it's not even on my radar screen. So I'm thankful that I trade 200 markets, so that trade can be really small. But I really segregate those trades that are profits into letting my profits run. And I'll get more nervous about a trade that is barely moving and has almost no volatility, but I'm getting ready to get out of it with a loss, my predetermined stop loss. So I've tricked my mind into looking at the markets in this way. And then I remember reading on Twitter, it was some stuff that I had posted and people were commenting And basically, after the intervention, it was something like, well, that's it for the CTAs. The CTAs have made their money. Now they're going to have a drawdown, which could be true. I mean, we don't really know. And that's sort of silliness. I just don't understand it coming out of people's mouth. Because one of the things we definitely learn in all of these situations is if you get too negative on Wednesday, you'll have to be very positive on Thursday. And so what you feel is not a good guide. And then what even happens on a daily basis is absolutely not a good guide. And my look back is a year, or something like a half a year. So it really is a situation where you have to um, keep telling yourself what's important, what's not. You believe in your strategy. And then I was like laughing at friends on Twitter who are buying, I, they're buying stocks, or I'm going to buy a little bit of stocks here. I just have never had that inclination. I definitely thought, I was talking to my friend here in New York, and I was saying like, nickel, the gilt is like nickel, you know? Yeah, it's just like nickel. It's outrageous profit very quickly, crazy moves in a day or two. And so we probably should just all get out, right? I talk about doing that, and I think about that sometimes, and I'm like, okay, the next time I see something like this, I might just do a discretionary lighten up trade, but I kind of forget about it and I don't do it. And so, but I think it's kind of funny that with these price moves, how they impact our brain. I try to like stay away.
People have such a quality, that such human bias, that when it's okay, that they think that it will be okay, it will be good all the time. And on the other side, when there's bad days, failures, problems, people say, and people around them think that it will be for a long time. So it's not, we are strong followers. We, in our philosophy, we use basic laws and basic principles. And according to these basic principles, we can see different periods, and we organize our trading to have benefits from it, to have benefits from these different periods. I mean, to not to lose in flat periods, and to maximize our profit in trend periods, to capture the trends, I mean.
Now, Jerry Parker just mentioned about the fact that he is trading 200 markets, and this week I was reading this UBS report on CTAs, which I find it phenomenal report. I've never seen anything else like that. So it's so detailed, and I'm sure some other traders have seen it. It's just missing a 50-page report on CTAs for the first time. Of course, they're talking about which as an overall industry, and in the CTAs, and they're specific to focusing on the trend following part of the CTA. So within this trend following bucket, in terms of the diversification, so the question is, we usually talk about the stocks, all right, because it is, everyone talks about stocks. It is easy to trade as many stocks as possible, but also there are many things available to trade on the credit side, and which just when I was reading the report, it just popped up to my mind. I mean, there are lots of bonds, right? There's corporate bonds, investment grade bonds, high yield bonds, the junk bonds, you name it. The entire bond market is as diverse as the equity market. So, and if you think about all the stocks, all the equities, you can easily trade not 1,000 but possibly tens of thousands, and if you want to go really as many as possible, possibly hundreds of thousands of instruments are there. So the real question is, and maybe Jerry Parker or the Richard Brennan have tested it, is there a limit to this diversification benefit? Because Jerry Parker usually talks about the more is better in terms of the number of markets. But is there a number where you must not diversify up, above that? You're already trading 1,000 markets with many bonds rates, and equities, but that's enough, or is it less than that, or is it maybe 200, 300? Because if you want to go as high as possible, there's more than 100,000 liquid instruments that you can actually go. So what is the number that we are looking for here? Does anyone have a number or any guide that it can provide? Thank you.
I think there is definitely there is a limit in terms of the correlation benefits you receive. So I think we can talk in terms of maybe up to 30 to 40 is sort of like the maximum correlation benefits you're going to receive in a diversified portfolio. But I think because we're targeting these outliers or these tail events, there is no number in our trend following landscape, because as you increase your investable universe, you are necessarily increasing the possible number of outliers in your distributions. So I think for most trading models, apart from divergent models, which are targeting the tail regions, I think there are diversification limits as far as you certainly can, go up to 60 to 70 to 80 markets, but you just find that with convergent methods under diversification, there is no sort of marginal benefit when you go beyond 30 to 40, because you max out the level of correlation offsets you can receive in that portfolio. But certainly then beyond that, this is where the divergent models shine, and it's different to other models. Your diversification is used for this hunt for outliers, which I personally don't think there is a limit. There's always selection bias in outliers. So because they're such unpredictable, sporadic events, you can never be confident with your investable universe whether you're necessarily going to catch a sufficient number of outliers. So obviously, the more markets you invest in, the greater the chance you're going to get a better distribution of these tail events within your distribution. But with that increased level of diversification, there's two things you've got to do. The first thing is you've got to reduce the number of trades per return stream. In other words, because we're hunting for outliers, if we take a market such as Euro USD over 30 years, there've actually only been three major outliers in that market over that 30-year period, of which you might allocate, let's say, 40 trades over that 30-year time horizon to try and capture aspects of those outliers. But as you increase the amount of diversification, you've got to be more selective in how you target those outliers, because what you're trying to do is you're trying to reduce the number of failed trades in your distribution to increase the number of successful trades in your distribution. So this is where you want to reduce your propensity to overtrade a particular return stream and be very selective in the trades that you participate in. So therefore, your trade signals need to be more selective in how they're targeting those outliers as you increase the level of diversification. So what you're achieving there is a greater relative frequency of outliers in your trade distribution to the relative frequency of what I call linear trades. In other words, linear losses and linear wins. You've got to try and reduce that so that your overall trade distribution has a higher relative frequency of outliers in it.
So if in that way, right? Are we talking about, because when you're talking about the frequency, reducing the frequency, I'm assuming that you don't want to add too many filters, right? Unnecessary filters that will actually disable you from actually taking opportunity of those outliers. But are you referring to something like longer term trading, or let's say increasing the time frame so that obviously your frequency is lower, or in what way are you?
Yes, Jay. Yep. So with the use of filters, it can be sort of like you can get it can be not an advantage to use filters. What filters can actually do is make your system more specific or more targeted to a particular outcome. I prefer not to use filters, but I prefer to use a longer look back. So go out to medium to long-term trends. So let's say you're using a Donchian breakout system. If you're trading a Donchian breakout with, say, a look back of 25 days, which is fairly short term, you're going to get a much higher relative frequency of trades. And in that, you're going to have a lower relative frequency of outliers to a higher relative frequency of linear losses and linear wins. But as you increase the look back to, say, 100 days to 200 days to 300 days, you're actually reducing the level of linear outcomes. You're still capturing the outliers because your signals are still activating on the major price moves. So what that's doing is it's actually pushing your trade signals further towards the tails of the market distribution, which is what we want. You don't want your signals to be activated too much in the bulk of the distribution, and you want them to be only participating in more extreme price activity. That way, there's a higher relative frequency of non-linear anomalies in your distribution than there are of what I call the normal outcomes of the distribution.
That makes sense. So you base depends in that sense.
And I want to say about filters, and it's I think rather interesting topic for me personally, because in a short-term space, especially, I think that filters can be useful, but to all the spaces, all the time frames, of course, we must understand, like Jerry said, that we must have such filters that will not filter out us from a big trade. It's very important. So, but in the short-term space, I think, and if you are limited in diversification of the markets, I accept filters, but it must be maybe. And one thing I want to say that maybe 6 years ago, I invented filter, or 6 years ago, I invented one filter for entry in the short-term space, and I like it. And I saw my drawdown, and I did the back test with my new filter, and I thought, oh, it's perfect. And because drawdown was reduced maybe on 70-80%, but I kept doing back test, and saw that in other period of time, in other market environment, maybe next year or so, there was the same result. So I saw the same drawdown with that filter in the place, in the period, where without that filter, I would not have a drawdown. So I didn't. Maybe I had a lot of research on this topic, and I did not found a perfect solution for filters. But I think if filter will not do something that you will miss a trade, it can be useful. But I.
Sorry to cut you off. I needed to get in there before I forget what I wanted to say, because I picked up on something I did not hear before. And but before I do that, I want to say in relation to this topic that trading the more markets, also we can trade smaller. And I have a tendency when I add markets to keep my risk budget the same. And so each trade can be a little bit smaller. The losses will be a little bit smaller. Or you can maybe even trade increase the risk budget a little bit and trade. But still, as Richard told us many times, that one of the biggest benefits of trading more markets is smaller bet size. And then and the problem that occurs when you sit back and you say, well, I'm short all of these bonds, I'm short all of these currencies, and so why trade all of them? And well, you see what happens in the gilt, you see what happens in the yen and the euro and the pound, and so you need to have all of these as many of these markets as you possibly can to capture the outlier, because it's not really a sector bet. I'm happy that I'm making lots of money on the currency sector or the bond sector, but sometimes we're hunting for these outliers and you're going to get unusual, bigger moves in some of the individual markets. So you have to trade them all. But what happens in managed futures, as apart from trend following, managed futures CTAs have a tendency to cut those profits short and rescale based on volatility. So they're pushing that yen and that euro and the pound back into looking more like the Aussie and the Canadian dollar, and then trying to push the gilts by getting rid of some of the gilt position as the volatility increases. That'll look more like the U.S. 10-year. So it is primarily can become one of these sector betting where I just have this wonderful little diversification. I'm making about the same on all the markets. If I had my druthers, I would be. I get very nervous if I see this outlier pop up. I'm going to slap it down and get out of some of it. Maybe I'm exaggerating a bit. But anyways, that is a different philosophy. So managed futures CTAs are not hunting the outliers and allowing them. Oh, they hunt them. They find them. They participate in them. They say that, oh, no, I'm still in gilt, but with a vastly reduced position. So a little bit of not straightforward semantics from them, in my opinion. But I really have never heard this other idea that Rich mentioned today. I may not have been listening closely. And that is this idea that with the more markets that I trade, I should essentially, it's better to become longer term. So I never did that because when I tested my system over, let's say, 50 markets, and I said, okay, I like these systems. They're very long term and they make the most amount of money given the risk, the stop loss risk. So as I start adding markets and I continue to go to 75, 100, 150, 200 markets, I keep doing these same back tests and I keep getting the same results, which these long-term lookbacks are great. They're fantastic. And I never experimented with I don't really understand a good reason to start pushing those back, those systems to be even longer term based upon the number of markets that I'm trading. I wonder, is it because, and then is that going to mean that is it only entry side only to do fewer trades and I keep the same exits so I don't try to become longer term on the exits? Or is it just I try to become longer term on the entries to where I do fewer trades? I understood everything else except the reasoning behind wanting to go longer term because I'm trading more markets. Sorry.
I think there's a couple of things going on there, Jerry. So when if I could I'll visually paint a picture that hopefully allows people to see what I'm talking about. So let's say I have a short-term system. Let's say I'm using a donkey and breakout short-term system of a 25-day look back, and I'm comparing that to a medium to long-term donkey and breakout system, let's say with a 200-day look back. Now, when I plot the histogram of trades onto a trade distribution histogram, I'm finding that both the short term and the long term, they capture the same degree of outlier. In other words, there might be 10 trades in each distribution of the short term and the long term, 10 trades in both, which is maybe, 10 10R or 10 ATR or 20 ATR or 30 ATR. They're capturing the same number of outliers in the distribution, but where the short-term system falls down is that you might have, let's say in the short-term system, you've got a distribution of 500 trades, and in the medium to long-term distribution, you've got a distribution of 70 trades or 100 trades. Now, the reason for the change in the number of trades is because of the look back you're using. But when you compare the histograms of both, you find that you're still capturing the same raw number of outliers, and the magnitude is similar. So 10 each. But where you're falling down with a short-term system is that you might have 400 trades or 450 trades, which are linear outcomes, a combination of small losses or small wins. But in the trade distribution of 70 to 100 trades of the medium long-term system, you've only got about 60 or 50 trades which are these linear outcomes. You're still getting, so pound for pound, the relative relationship of the outliers to the distribution is much greater in the medium to long-term system than it is in the short-term system. Now, there's a couple of things going on here. One is that as you are able to capture more outliers in your distribution, your dependence on correlations reduces because these outliers are unpredictable in nature. And you find that when you're in these true outliers, they don't necessarily correlate to other markets. The nature of the outlier, these anomalies, there is no sort of correlated relationship between the outliers. There certainly is a correlation within the normal distribution, which you want to avoid. So as you step out to the medium to long term, you're reducing the need to mitigate against correlation impacts, and you also are increasing the relative frequency of outliers in your total distribution, which, you know, pound for pound, is much more beneficial to your P&L if you step out to those medium to long-term timeframes. I've done a fair bit of research on this, and every time I do it, comparing short to medium-term to long-term systems, I'm finding this scenario unfold, which to me clearly tells me that as I'm increasing the level of diversification in my systems, I want to be more selective in how I participate in those outliers, because what it's doing is it's eliminating the correlation impact in the portfolio, and it's also increasing the relative distribution of outliers in my distribution.
And I want to say here that maybe it's another topic, but for me, personally, when I do a back test in a long-term system strategy, it's more informative for me because, for example, I have done 20 trades in a long term. In 2 years, I have done theoretically 20 trades in a long-term space, and I have done 20 trades in 1 month. So this 20 trade in 1 month, it will be, and I have said this idea before, it will be the same environment. And the 20 trades in 2 years, maybe 5 trades in one environment, 2 trades in another environment. So I mean that we must test our system in different environments. So if we are talking about sample size, I think that 5,000 trades in long-term space is valuable, but 5,000 trades sample size in a short-term space, I don't think so, because I have did a lot of research on this topic. I don't think that it's, of course, some level of validness it has, but I think that we must test in different environments our systems. It's very important.
I think Alp's question was very good. And of course, the number of markets you trade is a function of the AUM. But conceivably, you can have a strategy and a meta strategy. Even if the AUM is low, you can monitor the strategy for, let's say, 1,000 markets, and then have a voting system to trade a meta strategy that tracks those outliers. And this is my next step. Also, conceivably, even if you have a large AUM, you can switch from stagnant trades to those who are that are in a strong trend, and this is another way to boost the outliers. Of course, those are all theoretical, and implementation is hard. And many things can go wrong and affect the performance of the system. But this is my next step. In the short term, I was doing for many years looking for inefficiencies. Let's put it like this: the trend followers look for outliers. The short-term traders look for inefficiencies, and to get inefficiencies in the markets that are getting more efficient every year due to the widespread information availability and also the algos. You need to data mine many markets, and this becomes too expensive in terms of time and resources. So if you are looking for inefficiencies short term in like 10 markets, you won't get many trades. You have to try like 1,000 markets. And this requires, computing power and time. Time is important in this to do this. Also with trend following, you can it's easier in terms of computing power, but you can conceivably you can have a meta strategy, and in your basic strategy you can follow many markets, because eventually how much you can invest because of margin requirements and everything else it depends on your capital. So this is my take on this. I want to ask Jerry, maybe switch to another area. I have the performance of his fund, but he's best to answer. What's the largest drawdown you ever had? And how did you deal emotionally with that? What did you feel? Did you feel sometimes like shutting it off, or how was it? How hard it was it? Thank you.
Yeah, good question. I definitely remember. Let me focus on the most recent period. Um, I haven't always had my act together. Can you hear me now?
Yep, that's good.
Okay. Yeah, I haven't always had my act together as good as I do now. I think the trade level calculation that Richard and I talk about is so critical. And but going back to COVID 2020 February March, just being up like 10 or 11% and then losing it back in just a few days, crap like that really is difficult, and I really didn't like it. And I was reducing my positions in sort of a discretionary way, just saying, okay, this is kind of crazy. The losses are really large. They're coming very quickly. My closed trade equity trade level wasn't in danger of being breached, but I don't know. I just sort of hated that period of making lots of money, early in the year, then losing it all back so quickly. So I do have in my arsenal this ability to reduce my positions when the markets are pretty volatile and crazy, and especially how they are moving, and my P&L is moving around based upon the recent P&L. So it's just really destabilizing. And I think coming out of that period, though, I just was reminded of some of the most important elements of trading and trend following, which is do the trades, reduce your risk possibly, but keep doing the right trades, the system trades. And then in some ways, these could be very good opportunities. These next trades, no matter how painful the drawdown was, the next trades that you're doing, shorting everything, selling everything, it actually turned out to be pretty good, period. And we were very right to continue to follow the system and do those trades. So I think we're going to have these emotions. The more you can put it on autopilot and learn from it and make some adjustments and changes, the better you're going to be in those periods. And I had some good ideas during that period and some bad ideas. And so I think that's the most important takeaway is do whatever you can do to reduce the risk to where you're more comfortable so you can keep doing the system trades. That's the most important thing. What does it take for me to get my act together, start following my system again? And sometimes it just takes a bit of risk reduction in the current positions across the board, decrease in positions, and a decrease in the future trades, make them a bit smaller, get your bearings, and get right back to following those systems as closely as you can. In the back testing, I've seen usually the drawdowns are about, the max drawdown would be something like twice as big as your annual return. So if you're trying to make 20% and you have a 40% drawdown, I would not be surprised at that at all. And that's being, I think, a little bit, that could be low. So just know what the back test looks like and what is normal, what has been normal. And hopefully, given the trend following model and the way it works, the drawdowns will occur after you've had bigger profits. So that's important as well. What is your trailing 12-month return? If it's very strong, you should not be too uptight about profit give back. You're letting profits run, you're having loose pants, and you're going to have a drawdown. Doesn't mean that the markets in your equity won't go back to new highs soon. So whatever mind games you can play with yourself to get yourself focused on reality and what the systems are designed to do, and not the peer pressure. I think that's the worst part, is allowing yourself to be influenced by relative performance. Your performance is, as a trader, is how good were you at following the system. If you can give yourself an A+, then you got to give yourself an A+ overall, because that's really what it all boils down to. The biggest problems I've had has been when I traded too large and the drawdowns were too large for me, and I should have traded smaller. So I think I'm better at that now, at the proper risk budget that allows me to continue to do all the trades.
And great words. I want to say that I'm impressed really, because, and I understand how powerful these words, because of course we must be focused on our principles, on our strategy, on our system, and not focused, not pay attention on all that noise. And maybe it sounds easy, but for me personally, it took years not to pay attention on this noise, and I saw how the miracle occurred, because it's you have true. If you do so, you stick your system, your mindset, your philosophy. You have true, consistent, really consistent returns. You have really consistent friends, people who understand you also. Because in our maybe investors and people who are around us, a lot of people do the same noise. They tell you that you are not right, that you are not in profit, the other people in profit, and you are not. So I think it's better to have such people around you who will understand you, or at least if they don't understand, don't do such hurting things. And it's, for example, the investors that will not like you when you're in a drawdown, the same people will tell that you are genius when you will be in a profit. And then they will again say that you are dumb or you don't know how to trade, and other people know how to trade when you are drawdown. So there's no sense on listening this. I think so.
Jerry, I want to ask you, on average, what's the percentage of discretionary trading in your trend following? And if you hadn't done that, do you think the results could have been worse, a lot worse?
Well, I definitely think that my results have suffered from what I would specifically call a technical term here, not following the system. So everyone's results are going to more than likely be less if you don't follow the system. You're randomly reacting, and if you get lucky and reduce the drawdown in one period of time, like let's say COVID, February, March 2020, then you're probably built into your cards underperformance at a future date. So I just think that, I think another thing that happens too is CTAs build into their system discretion. And they think that just because it's a rule, that it's okay. And that's not true, because really a better definition of discretion is just low sample size. So if you have a rule built into your system that says when something uncomfortable happens, I'm going to get out. Well, that's discretion if I do it, but a lot of CTAs have that very thing built into their system, and it's just a low sample size event. I don't like pain. I don't like this sort of drawdown. I'm going to have a rule as if that rule makes it right. The rule is right if it's rooted in sufficient sample size. So
I've lost you, Jerry.
you're going to, how about now?
That's
Well, you're
good.
going to step in sometimes and do some things that will allow you to survive, and even though they have low sample size. So hopefully it's infrequent and not a daily dose, a daily diet of sort of discretion. Systematic discretion is what I call it. I have a rule. It's not based on very much. I feel like I'm just following my rules. That's crap. And so we're all willing to do some things to reduce risk, for instance, an across the board risk reduction to keep us alive and preserve our capital, even though we know there's not a lot of sample size. It's infrequent, and we have a good reason to do it because we're in this unhealthy drawdown. And then we need to go right back to following the system and promising and trying not to do that again. And a big part of it for me was if you frequently overtrade and trade too large, you're going to be making these cutbacks too often. If you have a better system and a better handle on your leverage that's going to make you comfortable, the only part of trading I think that should be somewhat based on each person's personality or whatever is then if you have a better handle on that, then you'll have to do these cutbacks less frequent, which is perfect because any trade that you do that's not part of the core system is not going to improve your performance.
And may I ask how do you approach to the gray swans? Because we usually talk about black swans, like the 1987 is a good example of it, or like the USD CVC or the nickel trading or the crude going to -40 or other black swans. But so because when the black swan event happens, we don't know about it. So the gray swans we know that something else is going to happen, and it's going to create a large volatility. I mean, has anyone else actually tweaked their system? Like Brexit is a very good example. I wasn't trading back in the Brexit referendum, but there has been 2 years of ramp up to the Brexit referendum, and at the night of the referendum, of course, the financial markets have become very volatile, the currencies, the bonds, and everything else. And when I look back, I'm not quite sure whether I would have choose to trade at night. It's just one night. Why don't you just turn it off and have a good night's sleep? And why don't you just follow trading from the morning onwards? It just resonates with me because you know that something else is going to hit you, but your system doesn't. Making sense? Thanks.
Yeah, that makes sense. I mean, I would describe it a bit different in that Brexit is a great example of something you kind of know is coming. And I think you just want to sit through it I'm not trading that. I'm not trading that night. I've had these positions on for months or years probably, and sometimes it's a win, sometimes it's a loss. I've had both. I was short when I think John Major got elected in the '90s, and everything rallied, and I lost 7% in one day. So then, fast forward a bunch of years, decade, and I have the right positions on in Brexit. So long-term trader, you sit through it. It's one of 100 markets, 50 markets, 200 markets, whatever. And so you should be able, and it's a profit. So segregate those profits from losses. If I'm looking at my stop loss the night before, then maybe I say, okay, I'm almost stopped out of these trades. I'll go ahead and get out. But if I have a big profit in them, I'm going to be bold and hang on and let those profits run. I just think sometimes it'll work, sometimes it won't. Your clients are paying you to follow the system. And they wake up in the morning and say, oh, great, I'm glad Jerry has the right positions on because I'm losing money in other parts of my portfolio. But at least I know Chesapeake had the right positions on for Brexit, and that's going to offset some of my other losses. then I call them up and say, no, I got out. I didn't want to sit through that. And they're like, what? Do your job, man. Follow that trend.
Hey, everybody. Going back to Alp's question about maybe what you did differently after seeing some kind of change, I would say after the crude oil thing in 2020 when, price went negative, I wasn't long crude oil. My system was short, and it wasn't short the contract that actually went negative. But just showing that as kind of a negative outlier, I decided that I was going to use in the market stops on all my positions at all times, just in the strange case that something I was in had some kind of really negative outlier move like that. I wanted to be out as soon as the stop price got hit rather than waiting till the end of the day. So, and Alp had a good tweet about this earlier today that got quite a few comments on, and a lot of people mentioned, or one person mentioned that not only did they not use stops, they don't use or they don't even have stops at all. They just use end of day exits, and it's more elegant. And that may be more elegant, but I wouldn't say it's more robust.
Well, I think I'm going to have to continue to stick with my definition of robust, and that is, do you have a sample? How big is your sample size on your rule? I don't think it's robust, but I think not doing what you do is riskier, and that's another lesson that I learned coming out of COVID, that you need to trade intraday and not wait to the end of the day. However, I don't think it matters much on the back test. I think it matters a lot for your sanity during those periods. And it's definitely it's definitely safer. It's safer to use trailing stop losses, even though the back test doesn't say that it's mandatory. And I think it's better to trade during the day than wait until the close once every now and then. I don't think it's going to show up to be materially better in the back test, which I've done, and but it can in the future be a lifesaver. So I have a hybrid approach, which is to trade on the close or trade on the open only unless all hell breaks loose. So then we'll just say, okay, today's the day. Let's start liquidating, and no more trades. We're not going to just wait to the close. But for sort of management reasons and administrative reasons, I think 99% of the time it's fine. But I agree totally, to that it can be dangerous, and it's irrelevant what you've seen in the back test is with an argument like this, because the back test can give you way too rosy of a scenario, and you don't want to pay too much attention to that back test.
Yeah, and when I've tested it both ways, end of day stops actually do a little bit better performance wise, but that's a that's a cost I'm willing to pay for survival, I guess, which I think is, should be goal number one.
I have tried to explain in my books and articles that hitting stops is a byproduct of sizing positions. To size positions, you need a stop. And I don't know why people don't understand this. And hitting the stop is the byproduct of controlling risk by sizing positions. Now, it depends whether your system is trend following, the outliers, or mean reversion, the inefficiencies. In the mean reversion, you have to go 100% in because the stops destroy the profitability of those convergence systems, as Richard calls them. So
That's so spot on, Mike. That is so spot on.
The way to control the risk of convergence system is by adjusting the allocation to those systems. Like you have $100,000 and you say, I'm going to trade only 20K for this mini reversion system. This doesn't work for trend following. You have to go all in. And as Richard and Jerry have explained numerous times, you diversify to get those outliers. So people confuse these things, outliers versus inefficiencies, and stops versus position sizing. Stops are a byproduct of position size. You can't position size without a stop. Now I have a question for Jerry here, the master. I use 0.5% for position risk. Do you think it's too low? If I increase it like to 1%, I get like a, larger drawdown. So I understand 0.5 may be too low. Like when I traded for a hedge fund, a Swiss fund, during the financial crisis, I was trading stocks and ETFs short term. I used like 0.25% per position, and that saved me. I finished the year nearly flat. I was lucky though, because one company was bought by another, and by luck I made some money, pure luck. But do you think 0.5 is too low, Jerry?
Well, I think 0.5 is too high, not too low. It's too high for me. And I think it's a function, though, of the number of markets you trade. So you have a risk budget and you split it up between 50, 100, or 200 markets. That's how I do it. So I would have a similar risk budget of how much I'm willing to risk in a typical day if every trade went against me, for instance, one ATR. And then, like I said, if you traded 200, maybe you could increase the risk budget a little bit. But basically, you keep it the same and then you divide it up between all of the markets. So I'm very happy that I trade 200 markets and I can divide my risk budget up between 200 and if I lose, when I take a losing trade, the full stop loss, I lose about 15 basis points. So if I traded half that, I would lose 30 basis points. So I think just in general, 50 is a lot, but it signifies to me I need to trade more markets, not too much more than that. And if you can't trade more markets, then you've got to risk 50 basis points. I'm targeting 15 to 20% return per year. So, but that's how you back into your number. If you only have assets to trade 20 markets, then you may have to risk a full stop loss might be 50 basis points or 100 basis points. But in general, I was so happy to trade more and more markets to make my stop loss way less than 50 basis points risk, and I'm very happy at 15 basis points. However, I trade a lot of different markets. They're very correlated. If 5 or 6 of them go against me in one day, I'm losing 50 basis points, right? So it's the same thing sometimes. You can't get away from losses. You're doing the best you can by trading more markets and having a reasonable risk budget based upon your tolerance. But it is nice to trade a lot of small trades because on some days the markets are all correlated and you get your ass kicked, but not that often. And it's much better to trade more and to risk more per trade, even though your risk budget is the same. And especially it feeds right into our goal of hunting outliers, not reducing the size of our trades based upon vol or correlation, and really letting those handful of trades turn into big winners. Yen, pound, and euro and gilt can be much different than their brethren in the same sector. And that is the main difference between trend following and managed futures, which managed futures pays more attention to the smoothness of the returns, the smoothness of the portfolio returns, where trend following pays no attention, or at least I don't pay attention.
That's such a good philosophy there, Jerry. You want the outliers to do the lifting power of your portfolio returns. You don't want to use leverage. So, if you're applying 1% risk, that's effectively applying greater leverage than, say, 0.25% risk. So you want the outliers in the distribution to do the lifting. You don't want it to be leverage that does the lifting. If you use leverage to do the lifting, you're going to find that you're going to have even higher drawdowns. You're going to have a much more volatile profile than if you're just using the inherent nature of the non-linear asymmetrical outliers to do your lifting power of your distribution.
And I want to say that I mentioned that people want to avoid risk at all. A lot of people, and even people with business experiences, professional experiences, in some fields, solid experience, and they like this idea to avoid any risk. And they think that maybe in finance it's real, but no. There is not this way, and people, some investors, they are willing to close their eyes and not to see the risk because they think it's this idea of avoiding risk. It's so precise for them. Maybe that what I have found. I have seen this human bias, but we all know that we can only control the risk. We can't avoid this, and without this risk, we will not have the results without having any risk. It's impossible.
And also, when we speak about like this, all right, because we've been here for some time now, we understand that, when we speak about risking 30 basis points, also, you mean to use a loose pants approach and use a large ATR stop to be able to size those positions. So if there's anyone else listening this for the very first time and, perhaps risks 30 basis points with 2 ATR stop, still that leverage is going to be too high. So it is worth, I think, mentioning for the new people who are listening this, we are talking about small risk, also a loose pants approach to be able to size those positions, so to avoid confusions. Yeah, thanks.
Exactly. The size of the stop loss, the multiple of the ATR is going to jump out at you when you do the back test, and you'll see the optimal loose pants on the ATR stop, and it needs to be a little looser. And then the size, if you risk 1 ATR, you're just going to have a lower win percentage, and you're going to have to get back in. That's another thing about everyone understands, right? You got to get back in. That's the problem the quote unquote problem with a lot of ideas and the frustration that we all face, even with the best ideas, is going to be, oh crap, I got to get back in. Filtering is one thing to slow the trade down. Let's say I have a filter, I'm going to get in soon if the market rallies a bit more, but I'm going to get in. Oh, you're always going to get in. And then as soon as you get out, you got to get back in if it goes back to the highs or the lows. And so that's a given. And I don't even talk about it. It's such a given. And one of the downsides is you have to resize based upon the current ATR. You put that position on with a low ATR, try not to get out of it too quickly. Hold on to it for a year if you can, if your system loose pants exit has not been hit yet, and be very happy because you sized that thing at probably an incredibly low ATR. And if your shorter term system knocked you out and you had to get back in, it's a much smaller position. So it's another key concept in maximizing outliers is what was the ATR at entry? And do you still have it on? Or that's the cost of trading shorter term, is resizing those trades. And a benefit of trading shorter term is you get out quicker when the market crashes. I preserve more profit. And when you do the back test, the computer looks at all of that and says, yep, you're right. And I'm going to tell you, I'm weighing the pros and the cons, the good and the bad, and here are the optimal parameters. And so you say, okay, thank you. And I'm just going to go with that. And it's going to suck on some trades and it's going to work out really great on others. But how it did on this trade or these trades or this year is totally irrelevant. It means nothing. I've seen this work. Yeah, I've seen it work too. But it's not a question of, does it work? Do dumbass ideas work? Yeah, they do work. And they'll give you relatively better performance sometime. It's not a question of that. It's how does it work over the entire test period? How is it going to work over the rest of my life? Because I'm going to be trading basically these systems and similar parameters for the rest of my life. And that's what I'm concerned about. Not this period, this week, these returns, and having seen something work. Yeah, a lot of crap works, but it doesn't mean it's the right thing to do.
Yes, but when I was doing my research for many years, I was doing my own research before I have discovered Top Traders Unplugged, maybe even 10 years ago, and I saw the same thing, the same problem, that I saw a lot of different things that worked. A lot of different things, and even maybe crappy things, like Jerry said. It worked for a while, for a period. And it was my dream to find something that is basic, that will work every time. To be adaptive. I understood even maybe 10 years ago, I understood that it must be adaptive stop loss. It must be adaptive. It must be big sample size and must be logic behind the strategy. And I didn't know the answers for that at that moment. But I want to say that, of course, and about risk, it's very important to understand that, and I have told this before, that when we are trading shorter term, our risk in fact increases. And when we have one ATR stop, our risk is more with the same level of risk. So if we have 1%, for example, of risk per trade, it's theoretical, of course, it's too big, per trade. And if we trade a long term, and we have 3 ATR stop loss, and we trade a long term system, so we have recent trades. We have less risk than we have a trade, say, every day with 1%. This 1% intraday trading can ruin your account, in fact. And I saw on the site of one company, London company, that the golden rule is to have 1% risk, but that company trades in short-term space, and I thought it's not good. 1% in short-term space, it's a very big risk.
This is exactly correct. So when we are speaking here, we usually talk about how much we are risking, but we sometimes just is not to complicate the conversation, miss out the other parts, the denominator side of the quantity calculation, and it is very important. So in short term trading, yes, I would agree. I think 50 basis points is a very is more tradable or less. I would say somewhere else between 10 basis points to 50 basis points is a more is a better risk management. And when you of course trade longer, you might want to trade with a bigger percentage. And sometimes we talk about this short term trend following or long term trend following, but I think there's a trend following as an investment philosophy. So the way, and there are various ways, I would say there's unlimited ways to adopt it, So I'm not I'm not sticking into, it's really not that important whether you trade long term or medium term or short term, as long as, your investment philosophy is in line to capture those outliers, to cut your losses, to let your profits run. So there's a lot of things that are common around what we do in our space, and the more capital we have, of course, then you will have the opportunity to trade both the short, the medium, and the long run. So that's the view that I take. Thank you.
So if you want to switch topics a bit, like I said, the last podcast that Richard was on, I really enjoyed it, and there was a bunch of things on there that I had questions about, and I didn't fully understand Rich's point, and we don't have to get into this one, but because the second one was really fun, but I didn't really understand Rich's points about information in the tails, and but the other part, a lack of information in the tails, wasn't exactly understanding that. But then the other part I really loved was Rich's research backtest that showed an optimal allocation to trend following was 64%, and the 36% was going to long equities. And I think that's a very good, fun thing to note. And I think that was from 2020, or 2000 to 2022, I think. But and I think that's going to go down, And I think if you look at the entire test period, it's more like 2080. I've done that research before, but it's always fluctuating and changing. And obviously, with CTAs hitting highs and stocks hitting lows, it's getting better and better. But so it's always in flux. But I think that's a pretty interesting situation, and that obviously assumes trading stock indexes on the long side, which would probably reduce performance a bit compared to choosing a group of single stocks to trade on the long side for the CTA portfolio. But great research, so much fun that the majority, rightfully so, if you look at the numbers, the vast majority of your portfolio should be allocated to CTA trend following. You have any comments on that, Rich?
Yeah, look, just in relation to the information in the tails, what that's about is that we've got to view divergent strategies differently to convergent strategies. So they're the antithesis of each other. In other words, when you look at the market distribution of returns over a very long period, like 30, 40 years, you find that nearly all liquid markets have this leptokurtic signature. In other words, they've got this peak around the equilibrium of the distribution, and then they've got these divergent tails to the left and to the right of the distribution. So an information-rich environment is where you can extract information that is predictable in nature, and an information-rich environment occurs around the equilibrium of that distribution, in other words, around the mean. So this is what convergent methods draw on. They're drawing on what I call an information-rich environment. There is a stable equilibrium. And this sets convergent methods up to exploiting these predictable characteristics of the market. In other words, if they are in a mean reverting environment, they tend to oscillate about this equilibrium from a period of an adverse excursion away from the mean. They then come back to that mean, and then they oscillate about that equilibrium. So there's another number of information sources you can draw on for your models. There's the equilibrium itself, and there's the standard deviation away from the equilibrium that I refer to as an information-rich environment. So this is characteristic of a market that is in stability. In other words, very predictable in nature. This is where pattern recognition flourishes. This is where value investing flourishes, because people are buying value based on the principle that it's going to mean revert to their intrinsic level. So a lot of trading methods, which are convergent in nature, are drawing on this information-rich environment. However, out in the tails, we're approaching an environment that is getting towards chaos. In other words, we're on the verge of chaos in these tail regions. This is where there is no predictable information in those tails. There is no central mean. There is no concept of a standard deviation. As you get towards the tails, the distribution, the form of the distribution changes to what is almost a Cauchy distribution or a pathological distribution, which is information deficient. Now, this is where the divergent methods exploit their alpha, because it's in this area of uncertainty, market unpredictability, where most of the trades we take are wrong. We have a very high loss, but we've got to mitigate adverse risk in this environment. So this is where we use our trading systems to mitigate the risk. In other words, we employ stops and trailing stops to mitigate adverse tail risk exposure, and we are totally capitalizing on the unpredictable nature of the outlier with these no profit targets and this potential unlimited profit potential. So we're using our systems as a device to constrain risk. We're not using information. The only information we can really use with our systems is what we derive at the entry point. At the entry point of our systems, this is before. We never know we're actually writing an outlier until the outlier has been and gone. It's a hindsight statement. So at the point of taking a trade, we know that prices move substantially. We assume we are still in the bulk of the distribution when we are taking that entry, but hopefully we are located somewhere close to where things become chaotic in nature. So at that point of entry, we've got a bit of information we can use. How far away should our stop be? We're using the information from the normal distribution for that. We're using information for our trailing stop to define our trailing stop ATR and our ATR of our initial stop. That's at the entry point. But from that point on, we've got to assume, because we never know if we're going to be writing an outlier, we've got to assume that it's going to get unpredictable from that point of entry on. And from that period on, there is no information we draw on. So that's why we adopt the standard bet size at entry. And from entry to exit, we do not tamper with that trade, because if we are legitimately writing an outlier, which we never know when we're trading it, if we are, it's going to be unpredictable in nature. Its magnitude is going to be significant. We cannot use predictive information techniques to manage risk in this environment. So we're using our systems to take over, to control that risk, but leave open the total profit potential. So that's what I mean. So the tail hunter is limiting the information they're drawing on by using their systems to mitigate their risk, as opposed to the convergent trader that is using information to hone their system for the characteristics of that market. And so a convergent system is never going to do well under diversification. A tail hunter is going to do very well under diversification. This is because a convergent hunter is using information specific to that market. What is the equilibrium of that market? What is the oscillation about that market? What are the patterns that are associated with that market? What are the patterns of stability around that market? That's why they are exploiting the characteristics of an individual market. We are exploiting the characteristics of tails that are present in any possible liquid market, but we never know when or where that's going to occur.
Can I talk, Jerry?
See, that's why you listen to Rich, because who talks like that? Who has all this wisdom other than Rich? This is why whenever you hear Rich is going to speak, or you got to go listen because that's a great explanation. Now, I was going to be a little picky with your words, and because although I think you may have convinced me at the very end, but I think that what I was going to disagree with a bit is that I agree with the part of convergent versus divergent. However, I felt like that I needed to say that none of the trades have this necessary information, not just the ones that turn out to be the outliers. But I guess at entry, we do. I was going to say, well, we do know that with the average trade has been the win loss ratio percentage. The win percentage has been the average trade. We do have some information that would say to us, hey, you should probably go ahead and do this next trade using the system entry rules. But I guess my point was in saying that we don't have information in the tails, were you trying to say that there is a bit more information at entry, but really once we put the entry on, we don't have enough information to do anything other than follow the rules of our system if it turns out to be an outlier or not an outlier, if it's just an average trade or a loss or a small win. Do you think there's more information there than absolutely no information in the tails? I totally understand that.
Yeah, look, I think a lot of the time we take a trade, people say, well, why the hell did you take that trade? Because clearly it's going to revert back to the mean. And, a lot of the times we find that occurs. And then we say to ourselves, well, they were right. It did revert to the mean. However, we've got to assume, because we are targeting these outliers, that at the point of entry, thereafter, because we can't adopt the predictive methodology with these tails, we've got to assume that every signal is valid, even though we know that most of the time we're going to get whipsawed out. And that is the signature that, well, in this instance, we weren't able to, capture the tails that might extend from that normal distribution. We're captured by the sort of the verge of the distribution where we're drawn back into the normal distribution. So that's just a case of the fact that, with our system, we've got to have a rules-based approach, avoid our brains interfering, because we've got to stand firm to our cause of targeting these outliers. So even though we know that most of our trades are going to lose, we know that over the long term with the distribution, we are going to get some significant outliers by not tampering with those trades.
But I was going to say, still, I wouldn't agree with nobody has that information because let's say in a bear market, right? You have winners and you have losers, right? You have obviously people that get liquidated, so that's moving the market as well. But you also have particular traders that actually move in the right direction. So technically speaking, if I go technically speaking, you do have people with information. It might not be information as to directly, let's say it's a company, they might not per se know if it's going bad or not, but they do move in the right direction. So in some way, they have a certain type of information that gives them the conviction to move that way, whether it's in their system or whether it's their own discretionary decision.
Yeah, I agree with Richard 100% the technical aspect, but please don't use that in a marketing brochure for trend following. And this is why people shy away from trend following, because those leptokurtic power law distributions, they may not exist, have infinite standard deviation and not define mean. This is the reason most big funds that have, the statisticians, they shy away. Most power laws in the market, they have infinite standard deviation. This means infinite risk of ruin. So we know this, and I agree with you, but you don't use them as a marketing pitch.
I love
Yeah,
that, Mike. I agree with you.
Oh, that's brilliant.
that-
I was laughing at the same time Richard was laughing. Yeah, that's good stuff. You're right. You're
yeah,
100% right. However, I will just say one comment to that, and that is that there are people who love trend following, and I have some of them as clients. And so it just means your business is going to be small, which is fine. You'll find a couple 100 million, 50 million. You can have a nice living um, and not have to work hard for a living. But you're not going to find many of these clients and institutions. But I would just say the one part that we all kind of disagree with, uh, classic trend following kind of disagrees with, and people who don't, they probably in an honest moment over a beer would agree as well, that this infinite volatility is different than infinite risk, because I'm looking at each one of these as trades, not as period returns. And I have some big profits in some of my open positions. And no matter how much volatility, I'm not going to lose money on them. You must join the other group and convince yourself that volatility equals risk, even if you have a very large profit that is making you lots of money. And we need to not believe that in order to keep doing the trend following.
yeah, Jerry, we agree, but try to convince all these quants that equate risk to standard deviation. And of course, standard deviation can be, the volatility can be positive, and it would mean higher returns, but not only negative, but they don't buy it. They don't buy it anyway. I wanted to say to Richard that mean reversion has many definitions. And when people talk about mean reversion, they mean different things. One is the buying the dip. That's mean reversion. Another is existence of a unit root in a price series. And in like trend following, we bet there is a unit root essentially that will diverge. That's why they call it divergent. And but anyway, these are technical things. And my point was that we know some things, but some people disagree with those.
Thanks, Mike.
Yeah, thanks. That's really good. We we agree. Um, you can be a good trader and try to do the right things. And I think the problem is though that some of the some of the ideas that get added on to trend following, I don't think it's safe to always assume that they're benign. And so it's not, if it was just all benign and it didn't matter, then I think I would be more persuaded. But I think some of the things that are globbed onto trend following are harmful in the long run. And it pretty much takes the long run to sniff these things out. So, yeah, you can be a good trader and not a great businessman. So I'm definitely guilty of that.
And I think that a good trader have more chances to be a good businessman. I think if he really will focus on this, I think it's a matter of focus maybe. But in fact, we as trend followers, we have as a mentality of successful people. We are persistent. We can manage the risk. We have a mentality of diversification. So a lot of aspects of successful mentality. So I think it's not a problem if a good trader will be focused really on the business side. I think it's less problem for him to be a good businessman than to a businessman to be a good trader. I think so.
what we find with convergent systems is they tend to use the market to manage risk. In other words, they tend to use the historical probability of volatility as a means to say, well, here is a stable, predictable regime. These are the model thresholds around which I'll apply my system. And they're constrained by the back test or the historical probability of that data assessment to manage their risk. Now, what trend followers do is we say, well, because we are trading in an uncertain environment, we can't use a probability distribution to define where our risk lies. So we use our systems as a way to mitigate risk. So we're using our stops and trailing stops to always mitigate that adverse risk, which is different to, say, buy and hold, which never applies those system constraints. It's relying on the market to manage risk for itself. Convergent systems, such as mean reversion, etc., they're using the market, such as correlation measures, all of these things to manage risk. We say that's not sufficient to manage risk because we're uncertain about the next risk event and where that might occur, despite what our backtest may say, despite what history has said. Therefore, we'll always use system constraints to manage that adverse risk. But what we don't do is we do not apply any system constraints for our profit. We allow our profits to run. So that's therefore forcing our distribution to have this positive skew, and it's forcing us to be, when the environment approaches these chaotic regimes, which we won't find in a backtest. So every time we do a backtest, we're going to find, oh, we shouldn't have applied stops here because the market was predictable over this period of time. But what we say is, well, the backtest isn't sufficient for our risk mitigation measures. We've got to apply something more concrete, something such as a system risk mitigator, such as our position size and our stop and our trailing stop. We're forcing this the minimization of the left tail of our trade distribution of returns by all of these concrete risk mitigation measures. But we are leaving our right tail totally unbridled with whatever the market wants to deliver to us. So we're totally, dependent on the market to deliver our fortunes, but we are risk mitigators in every way, shape and form in protecting our left tail exposure.
Brilliant stuff. And I was reading, I think I saw an article recently that all the devastation on risk parity has delivered to the people who adopted that idea too. No matter how you slice it, you're going to get in big trouble one of these days if you don't have a trailing stop and a stop loss, and you're going to miss out if you can't go short. So these shortcuts that people come up with, risk parity, based upon historically looking at probabilities and what's happened in the equity curves versus, for me, just taking away the least a bit of information I possibly can. This is a pretty good place to buy. This is a pretty good place to sell. My average trade is X. My win percentage is Y. Now I'm going to go forward with no other knowledge that when I bet 1, I'm going to earn about 3. But how those cards are dealt and how they pop up may not look like anything like history. And I'm using history only to determine my entry and exit parameters and to try to ensure that I have a healthy, juicy trade and a healthy edge going forward. But fade the back test as far as the equity curve.
Jerry, I shied away from trend following for many years because there is a huge volume of literature, academics that claim it doesn't work, but we know it works. And they claim it works because of survivorship bias. And I always wonder how much of success in trend following is due to discretion, discipline, and also being able to sustain these drawdowns and also deal with the diversification, have a large AUM.
Well, I'm pretty sure that in my back testing that if I use a very long-term system and using lots of markets with one entry, one exit, and a stop loss, there is no CTA with as good a track record as that. And so I don't think anybody beats the back test. So any discretion has been a reduction in performance, whether it's my kind of discretion where I reduce positions and try to preserve capital, or whether it's built-in discretion, that systematic discretion that has non-robust rules, low sample size rules to smooth out the equity curve. So I don't see any live CTA, managed futures person, trend follower with as good a track record as the simplest and most long-term, the easiest replicable backtest. Certainly not me. And it's depressing on one hand, but it's comforting in another that you really can't beat the rules, and you'll always be rewarded for following them and being the world's greatest trend follower and knowing nothing else but trend following. I wrote a couple of forwards recently to some books that are coming out. People asked me to write a forward. I can't tell you how painful it was to write. And I just don't know why I have such a phobia. But I finally finished my forwards, and the people were so gracious, even though I was so late in turning them in. But in one of them, I included this wonderful quote. It's not mine. I don't remember where I got it from. When I first heard it, I know I tweeted it, and it was something like, I wish I didn't know now what I didn't know then. So I wish, coming out of 1988, when I started Chesapeake, I wish I had always had one entry, one exit, and a stop loss, continue to trade only that way, and only making the decision to make the parameter changes more long term, and continuing my commitment, my obsession with adding more markets, trading more single stocks, the biggest mistake that managed futures has ever made, not embracing single stocks. And I wish, most of the time I do wish I didn't know now what I didn't know then. It's a beautiful quote and so true that with all of the experience we have, I'm not diminishing the importance of experience. There's a lot of baggage that comes with experience as well.
Something I've found, I track the performance of the CTAs, and something I find is that those that adopt what I'd regard as more classic trend following, you find that they don't go out the back door. They might have periods of underperformance, and they might retire from trading after a period of time due to a degree of underperformance, but they don't go out the back door. So when you track over a very long time period, the validated track record of those programs in the CTAs that have, 15, 20, 30 years of track record, you find that over the course of time, the percentage of trend followers actually remains high. So the TTU trend following index that I construct with Niels currently has about 55 trend following programs in it, which have had a track record of at least 15 years. Now, I don't find that in the balance of the CTA space, which practice a lot of other techniques, apart from trend following. They might have a period of stellar performance over 3-5 years, even up to 10 years, but they don't survive over the long term. So this is where this survivorship bias comes in, because I find that there are periods or unfavourable regimes which absolutely nail certain programs that don't adopt the philosophy that we're adopting, and they go to risk of ruin. It's not that they underperform before they retire; they go out the back door. It's a bit like ARC's Cathy Wood. We've got a 70% drawdown, and personally, I don't know how she's going to recover from that. But you find that trend following is a very robust technique. It's a bit like the cockroach technique. You can't kill us. We can underperform, but you just can't kill us. I think that's the way we view the trend following philosophy.
Exactly, but I can help you out with Kathy because she just creates new ETFs and increases the fees. So that's the latest on her. But before we sign off, Rich, did you want to mention? Thanks, Michael. Did you want to mention your research with the 3664 research that you did?
Yeah, so what I did was I said, all right, we're obviously having troubles with the classic 60-40 portfolio. Let's look at a way we can produce a better allocation mix using trend following as opposed to bonds in the portfolio. So we had the classic 60% equities, 40% bonds, which held up well until 2022, but only held up over the last 20, 30 years, while they were both negatively correlated to each other, but now they're clearly both positively correlated, and we're getting significant underperformance of the classic 60-40 portfolio. So I did a bit of research that said, all right, let's use I think I used the SG Trend Index as an inclusion into the 60-40 mix, where I eliminated the 40% bonds, and I said, well, what level of SG Trend should I put in there over a 22-year track record? And I came out, I think it reversed the ratio to 64% trend and 36% equities produce the optimal solution for at least the last 20 years. But we've not only outperformed the 60-40 up to the 2022, but in this particular 2022 period for the last 6 months, it's absolutely skyrocketed. So we've been uncorrelated as opposed to negatively correlated over that entire period, and we have outperformed the 60-40 index, which I thought was very interesting. So the thing about negative, if you're relying on a portfolio that's negatively correlated, such as the relationship that existed between equities and bonds, I find it's actually a much better, lower risk solution to actually have an uncorrelated relationship as opposed to a negatively correlated relationship, because we know that correlations break down over time, and you can't ever rely on the positive correlation or the negative correlation, but an uncorrelated relationship is a much wider relationship than a negatively correlated relationship. And over the long term, I think it's a much more powerful relationship to use for allocation measures, being uncorrelated as opposed to being negatively correlated. I hope that makes sense.
Yes, Richard. I also had an article, I don't know, 2 months ago in Seeking Alpha about 60-40 allocation to bonds and managed futures. There is a problem, though. The SG index is not tradable. So essentially what we are doing is some kind of data mining. Now, let's say someone had $500,000. You can't buy the SG index. It's too expensive. Now, you have to select a few CTAs. What about if you select the CTAs that are in the left tail? Only recently, the first ETF came about that you can trade managed futures. And although it tracks the SG index closely, as you know, I have also put some in Twitter, some charts, we don't know what is going to happen in the future. And another thing, you go to CalPERS and they have 500 billion. If they put this liquidity in managed futures like 10%, the returns will disappear.
Michael, just quickly, the report that I was reading, the UBS's report suggests that the total CTA assets under management is 375 billion as we speak. So if someone else allocates 50 billion more, I don't think this is going to create any significant deviation from what is happening at the moment. And they were suggesting that the assets under management is basically 10% of all hedge funds. Just to give you some flavor. Thanks.
Yes, I know. I saw the report. It's 385 billion. CalPERS, the fund, the pension fund is like 600 billion. And if people start pouring money in the space, the CTA space, the returns will disappear. In my opinion, it's better to stay like the way it is now, a niche space.
I'm not quite sure. So you're saying that if everyone else is going to be a trend follower, then the trend follower returns are going to disappear. But we discussed this a few times, and there are views who think that if more people are going to be trend followers, perhaps our returns are going to be much better. If everyone else is going to trade like us, at the moment, significant majority of people trades buy and hold or 60-40, and if we get some more allocation into the trend following space, I think we can benefit out of it, not get worse of it.
I agree, Alp. And this is what Mike's said. So when Mike's talking about convergence, he's talking about inefficiencies. When we're talking about tails, we're talking about these structural inefficiencies. And I personally think that these power laws that we find in the tails is brought about by more people doing the same thing. In other words, the participants shift to all doing the same thing, which causes these anomalies, these unidirectional anomalies or trends. This is different to convergence. In a market that's around equilibrium, you find that arbitrage gets eaten very quickly over the course of time. So the more participants doing the same sort of thing in a convergent market environment actually eats that arbitrage and it disappears. But I do find that in the divergent tails, the more people that are doing the same thing amplifies the trend in the divergent tails. So I personally think you can't use the same assumption for the markets in equilibrium versus markets towards chaos. There's different things going on, and the reason we get these tails is because of this amplified synchronous behavior in the markets where people are either bailing from their strategies and forcing the trend in the same direction because they're taking the same signal on exit as the people that are trend following, and this is causing this amplification or this power law in these tail regions. So I agree with you, Alp.
Yes, I agree, but there is a problem here, in my opinion. You assume there is an unlimited pool of funds, although this trading is zero-sum game. And in the 80s and 90s, the CTAs made money because of a large pool of uninformed retail, which doesn't exist at this point in the futures markets. They all move to stocks, crypto. So yes, these trends will be amplified, but when everyone tries to get out, there will be reversion to the mean. So trend following the divergent systems will turn to convergent systems, and the profits will evaporate due to crowding effect. So the people that claim, let's all go trend following because this way the oops.
We've lost your mic.
I'll get him back on. That was not me. I kind of concede both points of view. Richard's, of course, and then the slippage and the false signals and the degradation of performance if you have too many people hitting the same breakouts at the same time. So, and then I think that's why owning some stocks at all, much less 60% or 30 6%, but having any long equities that wouldn't be better suited to have in your trend following portfolio and trend follow those equities. It sneaks in the portfolio because you have these V tops and V bottoms that that Richard was talking about, where everybody tries to get out of their stocks at the same time, and then as soon as the trend followers get short, it rallies. And so, if that is keeping trend following equities from having the type of performance that would make buy and hold long only equities unnecessary. But that can change over time as well, to where I think that the allocation to buy and hold can get smaller and smaller. And my research showed that if you look at the entire test period, it's a low number, 20%. And but it's certainly not something I'm willing to have as much confidence in as a systematic strategy with currencies, commodities, and bonds. And I'd much prefer the stock piece that I have to be trend followed versus sitting through. And then another thing I wanted to say on Michael's point is that there's a lot of smart people who did not get short stocks and bonds and protect themselves. So I think they deserve to be in that same unsophisticated camp as retail people.
I think Michael's back on.
Yeah, sorry, something happened here. My point was that the non-stationarity of the prices that benefits trend followers disappears. It becomes more of a random walk when a lot of money comes in, because at some point people want to take profits and the reversals are violent. So, like, if I had a fund with $100 million today and someone says, I will give you $5 billion, I say no. I prefer this to stay a niche market and, make a good living, and don't go for the big one, because the big one comes with wild swings. That's my point. Especially futures trading is zero-sum game. Now, stocks is a different story. You have some wealth creation, dividends, and maybe that's why Jerry suggests going into trend following stocks. But as far as the traditional managed future space, the more money that will go in, and the big funds, the big allocators, they know this. That's why there is this cap at, historically, like Alp said, if you look, it's like a uniform distribution of the AUM for many years, at around, between $300 and $400 billion for the space. Okay, that's what I want to say.
I think we can be happy that trend following probably will remain niche for the long-term future, because people don't have the fortitude to invest with this philosophy or this technique. They might like what we deliver, but when it comes to putting the test to the metal, they will inevitably bail because they don't have the patience, they don't have the systematic processes, and it's a totally different kettle of fish to turn an investor into a trader. They might like what we deliver, but they certainly can't emulate it.
And
that puts a smile on my face. And I think because one of my main concerns is just for it to continue to work. And so you're sort of laying out the reason that it's probably going to remain niche, and that's okay. And it's probably going to always work. And that's wonderful too. So anyways, I'm going to have to move on and get my work day started, and wish everybody a good weekend, and thanks for being here. And like I said, if you want to hear some great stuff about trend following, go to Richard's website and Top Traders Unplugged and listen to those podcasts. They're quite amazing. And no one's more prolific on Twitter than Michael. and he posts great stuff every day throughout the day. So thank you guys for being here, and we'll see you next Friday. Thank you.
Bye, everyone.
Have a nice weekend.